Hello everyone, I'm Twinkle Jain and today we are going to tackle a topic that can cause a lot of anxiety for investors, market volatility and its impact on mutual funds. Market ups and downs are inevitable, but how you respond to them can make all the difference in your investment journey. So, let's explore how market volatility affects mutual funds and what strategies you can use to safeguard your investments. First, let's understand what market volatility is. In simple terms, volatility refers to the rapid and unpredictable changes in the price of assets in the market. It's like riding a roller coaster. There are highs and there are lows, and sometimes it can feel like a wild ride. For mutual fund investors, market volatility can cause the value of your investments to fluctuate significantly in a short period of time. So, how does volatility affect your mutual funds? The impact largely depends on the type of mutual fund you're invested in. Equity mutual funds are more susceptible to market volatility because they invest in stocks. During periods of high volatility, the value of equity funds can swing widely, which can be unsettling for investors. For example, during a market downturn, the value of your equity mutual fund might drop sharply, leading to potential short-term losses. Debt mutual funds, on the other hand, are generally less affected by market volatility. These funds invest in fixed income securities like government bonds, which tend to be more stable. However, debt funds are not completely immune to volatility. Factors like changes in interest rates or credit risk can cause fluctuations in the value of debt funds. So, what can you do to protect your investments during volatile times? The first and most important strategy is to stay calm and avoid panic selling. Market volatility is a natural part of investing, and reacting impulsively can often lead to poor decisions. For instance, selling your equity mutual funds during a market downturn locks in your losses and prevents you from benefiting when the market eventually recovers. Instead, consider the strategy of rupee-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you end up buying more units when prices are low and fewer units when prices are high. Over time, this can help smooth out the effects of market volatility and reduce the average cost of your investments. Systematic investment plans are a popular way to implement rupee-cost averaging in mutual funds. Another strategy is diversification. By spreading your investments across different asset classes, sectors, and geographies, you can reduce the impact of volatility on your overall portfolio. For example, if you're invested in both equity and debt mutual funds, a downturn in the stock market might get offset by the stability of your debt funds. Similarly, investing in international funds can provide exposure to global markets, which may not be as volatile as the Indian market. It's also important to review your asset allocation regularly. Your asset allocation is the mix of different types of investments in your portfolio: equity, debt, gold, and others. As market conditions change, so does the value of your investments, which can lead to an unbalanced portfolio. For example, during a bull market, your equity investments might grow significantly, causing your portfolio to become more equity heavy. In such cases, rebalancing your portfolio by selling some equity and investing in debt can help maintain your desired levels of risk. If you're nearing a financial goal, consider shifting to safer investments. For example, if you're planning to use your mutual fund investment for a down payment on a house or for masters abroad in the next year or two, it might be wise to gradually shift your equity investments into safer debt funds as you approach your goal. This reduces the risk of market volatility affecting your ability to meet your financial objectives. Finally, consider consulting with a financial advisor. If market volatility is causing you concern, a financial advisor can help you assess your risk tolerance, review portfolio, and suggest appropriate strategies to weather the storm. Found this insightful? Keep a lookout on this space for more such content. This is Twinkle Jain helping you make smarter investment decisions.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.